Thank you for standing by, and welcome to the Scali Limited First Half 26 Results. All participants are in a listen-only mode. There will be a presentation followed by a question-and-answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to turn the conference over to Mr. Anthony Scali, Managing Director. Please go ahead.
Good morning. Welcome to the results presentation for the first half FY26. Looking on page 2 of the summary, for the ANZ Group, written sales were up 10.5% versus prior year. Revenue was $251.7 million, up 13% on the prior year. The gross profit margin was 65.9%, up 1.5 basis points on the first half and 0.9 than FY25. Net profit after tax was $46.6 million, up $10.6 million or 29% on the first half FY25 underlying, and up $12.5 million or 37% on the first half FY25 statutory profit. For the UK, revenue was $17.6 million, impacted by store closures due to the rebranding program. Written orders for the first half were $21.7 million, with January written orders $6.7 million. The Scali brand stores, like-for-like in January, are up 32%. Gross profit margin in the first half 26 was 59.2%, compared to 45.1% first half FY25. 16 stores refurbished and rebranded as Scali by December 25. Net loss after tax of $5.6 million as per forecast. For the group net profit after tax was $41 million. Cash and bank deposits was $91.7 million as at December, and the interim dividend of 39% per share fully franked. Turning to page 3, written sales orders and group revenue. As mentioned, the written sales were up 10.5% on the prior year across Australia and New Zealand, with like-for-like written sales orders of 10.1%. The UK written sales orders was $21.7 million. That was 12.8% on the prior comparable half. Year-on-year comparatives are not representative of trading due to the numerous store closures for lengthy periods for store refurbishments. The group written sales order total was $251.6 million, 10.7% up. On the revenue side, ANZ Group revenue was $251.7 million, up 13%. This reflected in the high written sales in May and June FY25, which was up 16% on the prior year, and a strong first quarter FY26, contributing to the revenue growth. ANZ like-for-like revenue for the first half was positive 12.7%. For the UK, the revenue was $17.6 million. That's down 38.5%. This clearly reflects the low written sales over the quarter for FY25 and first half FY26, caused by closures of numerous stores for lengthy periods for store refurbishments and rebranding. Group revenue for the half was $269.3 million, up 7%. Turning to page 4, group financial performance. As mentioned, the gross profit margin was 65.9% compared to the first half FY24 of 64.4%. The ANZ underlying operating expenses increased by $5 million compared to the prior year, mainly attributable to employment bonuses and additional marketing in line with sales growth. The UK gross margin continues to improve, with Nick Scali product in place and the legacy FAG product now cleared. First half FY26 gross margin was 59.2% compared to the first half of FY25 at 45.1%. The UK revenues are reported net of interest-free subsidy costs, impacting margin. For the first half, 26 operating expenses in the UK were $10.8 million. In local currency terms, expenses were in line with prior year, with savings in employment and property costs offset by additional marketing spend. I'll now hand over to Kylie Archer, who will deal with the cash flow and balance sheet.
Thank you, Anthony. So looking at the cash flow slide number 5 here, total group pre-tax operating cash generated after deducting amounts due on operating leases was $51.5 million for the half, compared to $29 million last year, with ANZ contributing $53.4 million. For the UK, we see operational funding requirements for the period decrease as the sales orders increase and capital requirements reduce as the refurbishments are completed, with net operating cash flows for the UK, cash outflows for the UK of $1.9 million. Property and capital investments for the group of $17.1 million include 2 property purchases in the period, the first being $3.8 million for land acquired in South Australia to be used for our new distribution centre, with construction due to commence this calendar year, and the second being $7.9 million for the Nick Scali retail store in Campbelltown. In addition, fit-out costs were incurred for a number of showrooms across Australia and the UK. $28.2 million was returned to shareholders in the period by way of payment of the final FY25 dividend. And finally, the closing net cash position for the group was $20 million as at in December versus $15.9 million last year. We move on to the balance sheet on slide 6. Inventory levels overall have remained broadly consistent during the half, as you can see from the table on the right-hand side of the page, with inventory on hand at $42.2 million, slightly down on June 25 levels of $44.6 million. We see an increase in property at net book value from $120 million to $132 million, due to the SA land and Campbelltown purchases as mentioned on the previous slide. Borrowings remain unchanged in the period at $71.7 million, with $43.7 million relating to property loans secured at less than a 30% loan-to-value ratio. The balance of the borrowings relates to the $28 million corporate debt facility, unchanged in the reporting period. I'll now hand back to Anthony.
Thanks, Kylie. So turning to page 8, UK summary. Sales orders continued to improve during the half as more stores were rebranded. The 4 rebranded Nick Scali stores trading like for like in January 2025 showed growth of 32%. The margin was 59%, this is net of interest-free subsidy. The margin is expected to improve over the medium term. Distribution progress has been made in restructuring the customer delivery model to reduce margin leakage. Leadership. Further consolidation of UK head office roles as Australian operational processes are adopted in the UK, driving greater efficiency across the group. Focus remains on retail teams in stores and evaluating and seeking new store opportunities. Looking at product, the bestsellers in the UK are now in line with the bestsellers in Australia. New product introductions based on Australian performance will be the norm going forward. Pathway to profitability. The break-even position is $51 million of sales revenue. New stores are critical for our profit growth, as is increased brand awareness. Looking now on page 9 of the store network, a new Plush showroom was opened in November 25 in Bendigo. A further 5 new stores for FY26 are being planned to open, which will bring the total to 6 new locations. In the UK, the Lincoln store was closed, and at the end of the lease, as we believe it not suitable to rebrand to Nick Scali as part of the ongoing optimisation of the UK store network. The UK refurbishment program is mostly complete, with 16 stores converted to the Nick Scali store design, branding and product range. A number of new store locations in the UK are under negotiation. Now turning to page 10 in the outlook. For ANZ, the written sales for the month of January 26 increased by 3%. Like-for-like written sales increased 3.2%. During the second half, a further 5 stores are planned for opening, with additional opportunities currently being reviewed. In the UK, with the store refurbishment now mostly complete, material improvements are being seen in written sales compared to the prior period. Total January written sales was 6.7 million. For the 4 like-for-like written sales are up 32% compared to last year. A number of potential new UK stores are currently in negotiation. Well, that now concludes our presentation, and we're happy to take questions.
Thank you. If you would like to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Tom Kierath with Barrenjoey. Please proceed.
Morning, Anthony, Kylie. Just the first one on January. I thought it might have been a bit stronger than 3% in ANZ, just given your lapping negative 8.5%, I think it was. Is there anything like in the promotional timing or the calendar or anything, or is that just a reflection of, a true reflection of how you're tracking at the moment?
I think what's happening now in November, the month is getting stronger and stronger every year. So we had a very strong November, being very close to the Boxing Day sales. That just seems a bit of a shift now because of that. And so you're getting quite a lot of, forward orders you might have got in January. We did see traffic was down in January by 7%, and sales were still up 3%, so conversion did improve. That's one thought. The other thought is maybe interest rates are maybe having an impact on the consumer. We're not sure yet. I think March and April will tell that story.
Yep, that makes sense. And then just the second one is just on your order bank. So you did obviously more profit than you guided to in December, which is more profit than you guided to at the AGM. What's the shape of the order bank like at the moment? Like, based on my maths, the order bank reduced by about $22 million in the half. I know you don't actually report that number anymore, but just be good to get some colour on the order bank and kind of logistics and just, how quickly you're getting product to customers.
Yeah, look, I think our lead times have probably increased by 3 to 4 days. So, yeah, we're delivering a little bit quicker, but not materially quicker. Yeah, we don't call out the order bank because it can create some confusion sometimes. And I mean, at the end of the day, our revenue is based on, for FY26, it's really about May to March sales orders. Written orders gives you the revenue number, if you like.
Is it fair to assume the order bank has reduced in the half?
No.
Okay. All right. That's all I've got. Thank you.
Okay.
Our next question is from Garth Francis with MST Marquee. Please proceed.
Good morning, Anthony and Kylie. Thanks for taking my question. The gross margin performance was good. It does feel like it's been a fairly promotional environment. have you had to engage, or has that impacted your promotional activity in the market? And then if you could just touch on FX and currency impacts looking and when you expect those benefits to wash through. Should we expect some to come through in this half, or is that more of an FY27 story?
Yeah. I would say, first of the margin, it did not impact our promotional activity. On the FX side, yeah, obviously we take forward cover, and that won't, the benefit of the currency, if there is any, won't be until the first half next financial year. And clearly, being in a competitive environment, you not necessarily will bank the currency. We might pass it on with further promotion.
Terrific. And if I may, one more, just the tax rate, that was the effective tax rate in the half was up quite a bit. Could you just maybe, was there anything in there that resulted in that? Were you not allowed to deduct UK losses, or had something else? Was there another impact that we should be aware of?
No, nothing out of the ordinary.
So is a 30% tax rate going forward more likely, or something?
Yeah, traditionally that has been the rate.
Yes.
Yeah.
Thank you.
Your next question comes from James Ferrier with Canaccord Genuity. Please proceed.
Good morning, Anthony and Kylie. Thanks for your time. Can I ask you first of all about the store sales team in the UK? You've been on a bit of a journey there to improve the quality, capability of that team. Where are you at this point in time?
Well, looking at the January results, say a lot better at the moment. So yes, I think the leadership, we've got good leadership in the UK, and they, I mean, it's always something that you continually work on, better sales teams. There's never any point you say it's as good as I can get, and it's never it cannot be never as bad. So I think we're making good progress in the UK, and we can see that from the January result.
But would you, like, if you use a benchmark like foot traffic conversion to sales orders, would you say it's now comparable with Australia?
It's improving. Yeah, not quite yet at Australian level. Next Scali Australia anyway. But it's improved a lot.
Yeah, understood. Second thing I wanted to ask about was marketing spend. Just in your earlier remarks, and maybe Kylie's as well, you mentioned that marketing spend in ANZ increased in line with sales. So if my math's right, that would imply that you spent about $500,000 Aussie on marketing in the UK. Does that sound about right?
It's yes, could be, yes, maybe marginally more in fact. You're converting Australian dollars, yeah.
That's right. So just based on that, when you look forward now, Anthony, and you sort of see the landscape as it is, sales trends, things like that, what are your plans with marketing spend in the ANZ business through the rest of the year? Do you sort of see it sort of pretty stable, or do you see an opportunity to lift it up, maybe reinvest some of that stronger gross margin? What are your plans on that marketing spend?
Yeah, look, it's something we continually manage on a month-to-month basis, to be honest. So depending, on the strength and the traffic into stores, we may, in certain promotions where we think we've got a strong offer, may increase the spend. It's something we manage. But if we do increase, it's managed. We're trying to ensure we don't waste money on advertising. We need to get the result, and we continue to invest, able to invest more as we open more stores. So that's beneficial for the whole brand.
Yeah. And then just lastly, same topic, but for the UK, how quickly do you see the trajectory for marketing spend as a percentage of sales to move up, towards maybe not to 10%, but towards 10%?
Yeah, I think, well, yes, 10%'s a lot. I'm not sure we want to get to that. I mean, well, depends. The marketing gets more efficient with more stores, and clearly at the moment we have quite a bit of waste in our spend in the UK because we've only got 16 stores and they're spread across the UK. So there's not a lot of opportunity for localized advertising. It's mainly national, and hence we're aggressively pursuing more stores to open in the short term, so we can then increase the spend in marketing, which increases the brand awareness, which does two things: helps the same store sales improve, we would expect from that, and a larger store network.
Yeah, that's helpful. Thanks for the colour. Thanks.
Your next question comes from Shami Nadapala with Bell Potter Securities. Please proceed.
Yeah, good morning, Anthony and Kylie. Just the first question is, on the UK like-for-likes, I mean, with those 4 rebranded stores that were trading last year as well, the 32% up figure, what sort of confidence does it give you on, firstly, the break-even position and sort of where some of these stores will hit revenue per store versus some of the Australian stores?
Yeah, certainly gives us, that's not the January number on the like-for-like stores was a great uplift. The whole January result was very good in the UK. Clearly, we need to continue that momentum, but, particularly in this half, which will get us, sooner to the break-even point in the short term. But look, I'm not so focused in the short term, whether it's a small loss or a small profit. What's really relevant is that we open new stores and continue with the strategy and have a conviction to continue to open stores and improve every aspect of the business, which we are doing. But yes, on the whole, really encouraging result for January.
Perfect. Thanks for that. And the second question, you talked a bit about, earlier it came up that pretty intense promo environment here in Australia, but margins have been very solid. Turning to UK 59%, I mean, how did that track? And into the rest of the second half, how will that balancing act of margins versus driving sales work as the brand awareness increases?
Yeah, well, look, our promotion. The first thing is obviously our buying strength is helping us have prices even on promotion that are very, very competitive and yet be able to deliver that margin. And that's particularly because of our lounge volumes across Australia and now the UK. So we are very confident that we're going to be more than competitive in our pricing, yet maintain this margin. And as I said earlier, we expect in the medium term that margin will improve in the UK. One thing to also point out with that margin is there's the interest-free subsidy cost that is included as a cost in the margin, which is not necessarily not here in Australia.
Perfect. Thanks for that.
Your next question comes from Sean Xu with CLSA. Please proceed.
Hello.
Hello, can you hear me?
Yes. Yep, can hear you, Sean.
Thank you. Thanks, Anthony. Just hoping to do a follow-up question on the order bank within ANZ business. Could you please tell me what's the implied GP margin performance for your order bank compared to the same time last year?
The implied margin on the order bank, well, it's going to be slightly higher, I guess, given what our margin has been delivering.
Cool.
So
Thank
we
you.
don't expect our margin it will be consistent with the first half to the second half, is what our expectation is, subject to, external factors that may potentially impact it, like a shipping issue. But at the moment, the order bank is in line with the first half margin.
Got it. Thank you. Can I just do another follow-up? So this is the same question I asked you 6 months ago. I'd love to have an update on this. So because of the U.S. tariff situation, my understanding is there's not excess manufacturing capacity in China from your supplier, with their manufacturing plant moving to Vietnam to cater for the U.S. export business. I guess I just hoping to get an update how Nick Scali is positioned to negotiate or renegotiate a more favorable term with some of your partners in Asia, please.
Well, that has been occurring already. Yes. I mean, the factories, a lot of the production for the US, all the production in the US has moved to Vietnam for many of the China factories. And yes, you've got more capacity in China, but that's been for some time now. So I think, yes, we've been getting better value, and we've had good support from the factories, but I don't see any more change now in respect of that.
Okay, thank you.
We have reached the end of our question and answer session. I would like to turn the conference back over to Mr. Scali for closing remarks.
Thank you, everyone, for attending the results presentation. And we plan to provide a good result for the first half and look forward to a good result for the full year. Thank you.
That does conclude our conference for